This is shocking. The IMF is warning all Americans. Hey, everybody, you're watching Bull Boom Bear Bust, back with another dose. BX4 Bull to the Bust. Let's go ahead and get right into it. Please make sure you are subscribed. The next few months, you're going to see things play out, I think, pretty close to what we've been talking about here. Second half 2024 has not been a letdown, but we've got a lot more fireworks ahead. And we're going to talk about the IMF warning to all Americans here in just a few minutes. First of all, consumers' worries about missing debt payments are the highest since 2020. We have to go back to that. We talked about that, a few reports ago. But think about this. Right now, we're at a point where we were when the economy was in a shutdown period. We're at a shutdown period level of confidence right now in the U.S. economy. Consumer Watch reported that U.S. consumers the most worried about missing debt payments since 2020. So what's going on? Well, we know about 1 in 5 people are maxed out on their credit cards. Now, there's been a couple studies. One study said 1 in 5 people have a maxed out credit card. Another one said 1 in 5 people are maxed out on their credit, like their entire lines of credit. Well, we've got a little more data on that today. And there was a poll, not so much a poll, but a survey put out by Mishtalk. And what they're saying is 37%, so more than the 1 in 5, because the 1 in 5 is about 20%. 37% have a maxed out credit card, a maxed out credit card. Not that all their credit is maxed out, but they have a maxed out credit card. And that was a bank rate study that just came out, reported by Mishtalk and a few others. So it's not looking so good for the U.S. consumer. We're told the U.S. consumer is strong because the consumer is still spending. So now you have people spending more for everything. And of course, the government loves this because that's more tax revenue. Think about it. When you pay a percentage of everything that you buy in taxes, then higher prices means more tax revenue for the government. So of course, the government doesn't want deflation. They don't want prices to go down. That's why you see countries all over the world choose to inflate instead of allow the cost of living to come down. Even though they say, and the central banks say they're trying to fight inflation, we know that's not true. One, because we look at the facts and the evidence, but two, just common sense tells you that more tax revenue with higher prices, that's what they want. They want more tax revenue. Speaking of tax revenue, this is pretty shocking. Take a look at this. To me, this is pretty shocking, folks, when it comes to tax revenue. Take a look at where we're at in this country here. Bring up this chart here. U.S. debt service. The net interest bill exceeds the Defense Department's spending on military programs for the first time ever, according to data out of the Treasury Department and the Office of Management and Budget. It also amounted to about 18% of the federal revenues, almost double the ratio from 2 years ago. So look at this. The U.S. government now spends as much on debt services as on defense. And we're going to talk about the IMF warning here in just a little bit, but it has to do with governments not wanting to allow deflation. They don't want lower prices. Even though they say they're trying to fight inflation, they don't want lower prices. That's the last thing that they want to. And the IMF actually agrees. And actually, let's go ahead and jump to that warning right now out of the IMF here. And here's how it starts off right here. World's 100 trillion fiscal time bomb keeps ticking. It's actually much worse than 100 trillion. When you look at the derivatives out of the banks, when you look at the unfunded liabilities, global debt's way beyond 100 trillion. Why do we have so much debt? Because there's no backing to the money. They can just create endless amounts at the click of a mouse. That's why. But take a look at this. Debt loads are set to expand globally. Folks, they're going to inflate unless something comes in and smashes the debt creation system. That would mean going back to a gold standard, something like that, which some people say is going to happen. Other people say we're going to see Armageddon before that would happen. But here, debt loads, the G7 countries right here. Look at this. Here's the forecast. Set to go up exponentially. And in the US, in the globe, in G7, right? So this is what the IMF is forecasting because that's the only thing that the governments want to do. They can allow deflation, but then a lot of people would lose their jobs. the people that are making these decisions would lose their jobs, because then people would realize how crazy everything was. Remember when home prices were going up before 2008, and I lived through this. I watched it happen. When home prices were going up, everyone was actually happier than they were after the bust, right? There was a few people that waited on the sidelines, like myself, waited for the bust, expecting the bust because they were paying attention. But most people were unhappy after the bust because a lot of job losses happened. A lot of people lost their homes, right? A lot of people had other financial problems arise out of the financial crisis, including many people lost their jobs and they had to shift into different lines of work. Well, of course, we saw what happened, rock bottom interest rates, the same thing that led to the housing bubble. They did it again. Ultra low interest rates, easy money, deregulation of the banks, no bank reserves. So now we have a housing bubble today that's much bigger than the one back then. And economically, things are much worse than they were back then. The debt loads are higher. It's just that people have accepted it as the new normal. So they think that things are actually good. They believe that the economy is doing good. But when the economy goes bust, people have no choice but to face economic reality. When they look back after the bust, they look back and they say, wow, that was crazy. Some people are doing that now. They're thinking that the way we're skating by right now economically, most people, 70% living paycheck to paycheck, people tend to think that that is normal, but they think there's no other way around it. They think there's no way because supply and demand, laws of economics, they think that things can't change. Well, things can change if the way money is created and being loaned out changes. It's that simple, folks. It's that simple. Why do you think we have all these countries, the BRICS nations plus, going to at least some metals or some backing of their currencies when it comes to their own currencies and trade? Now we're going to see how it plays out here. We have a couple days, actually less than 48 hours until the meeting starts out of the BRICS nations. We're going to see maybe a big announcement. There's a lot of people expecting certain things to be announced, right? We're going to keep an eye on it and we'll be here reporting on it for you. But that is the start of this move towards at least towards a more sound currency, not a completely fiat-free currency, because having a fiat currency means no backing at all. So this will be partially backed, again, if these countries actually follow through with what they're saying they're going to do. Now, if they want to get away from the dollar, they have no other choice but to at least back their currency with something tangible like precious metals. All right, people, on to some other news. Kmart. Believe it or not, Kmart still have a branch open, a couple branches, but they just closed their last full-sized branch. I guess there's some mini Kmart now still open in Florida, and that's the last one. But the last full-size Kmart recently closed. Kmart closed its Bridgehampton store. I believe that's in New York. The last full-size outpost in the continental U.S., a mini version of the once giant retail, remains in Miami. It's interesting how certain small businesses can open up and remain open, but Kmart, it's got a globally recognized name. I mean, everybody knows Kmart, right? Can't keep more than one or two branches open. In fact, this will be the end, unless you count the mini branch in Florida. That'll be the last full-size branch, and it's now closed. And you would think people would want more options and that more people would go to Kmart, but Kmart was going downhill a long time ago. I remember in Riverside, where I have in-laws, we'd go up there to visit a lot. And we'd go into Kmart, the aisles would be all in disarray. They'd be out of stock of a lot of stuff. The prices were actually not that good, even kind of high compared to even Walmart. But this is the Walmart effect, folks. I mean, do you think Big Lots might have stayed in business if it weren't for Walmart? Do you think Bed Bath & Beyond might have stayed in business if it weren't for Walmart? Now, some people say that's good. Those other places like Big Lots, Bed Bath & Beyond, they were overpriced. So many would argue that Walmart deserves to be the biggest retailer and stay in business because they have the lowest prices, right? You hear both sides of the argument, but my concern is when all competition is gone, maybe not all, but when most of it's gone, which it's headed that direction, will Walmart keep their lower prices? We see this in business all the time. When businesses get a competitive edge, they don't lower their prices, they raise prices even more, because when the competition is eliminated or minuscule, they'll raise their prices. Name something that's went down in price. I mean, look at your cable bill. Look at your entertainment packages. Netflix, right? Raising their rates all the time, raising their prices. All the food joints raising their prices. Now, of course, there's a big backdrop of inflation and the demand for higher wages. But you get my point, right? See what I'm saying here? And folks, we have another warning out. This is out of the former Target executive warning about consumers running out of money. Now, we heard from this Target executive before, but it's interesting because the media is still out there portraying the economy as something strong. But most people know that consumer spending is up because of the high cost of living and high rates here. But here's what was said here out of the former Target executive quote. It's very clear that consumers are running out of money. They're increasingly stressed by inflation and the exhaustion of their pandemic era savings. That's the drop in the savings rate that they actually went back and revised. Now they're saying it was about double of what it was, which we know is not true. When you take a look at over the last several years, you see month after month, everyone talks about the consumer is still spending. They might be, but they're spending less than the growth of inflation. That's Storch Advisor CEO Gerald Storch in a recent interview. And let's go ahead and bring up a chart on this. Let me get myself out of the way here. Record high credit card debt. And this chart also gives us the savings rate even after the revision, which is now, instead of 2.9, they're saying it's 4.8%. Even after that upward revision, go back to early 2016, we're still below where we were in 2016 as far as the savings rate. But yet, look what's happened to credit card debt. Explosion higher, especially ever since 2020. Right? So if inflation was coming down, for real, if the cost of living was coming down, why is credit card debt still exploding higher? Because prices aren't coming down. It's just the rate of the increase of inflation is slowing. That's what we're supposed to be excited about. That's what consumers are supposed to be gleeful and happy about. But it's just going to get worse, folks. I've been saying that here for a long time. What's going to happen? Well, your guess is as good as mine, but I think it's going to continue to get worse. Now, will there be a breaking point where we see a crash in deflation like we did in 2008, or will they just continue to inflate? I think if everything goes as planned, they will continue to inflate. It's not just me saying that either. It's common sense, it's logic, and also the IMF comes out there and they say that's what they're going to try to do. Now, could something massive come in and disrupt the whole inflation scheme? Absolutely. We've seen it happen usually every 10 years. We're kind of overdue for a correction now, but we see something come in and completely disrupt the financial system every 8 to 10 years. But of course, it's been only 4 years since 2020. That was a minor disruption, even though that should have been massively deflationary. Home prices should have came down by 50, 60, 70%. But instead of allowing deflation, they chose to inflate. They chose to eliminate foreclosures, eliminate evictions, all these rescue programs, stimulus checks, corporate bailouts, bank bailouts, you name it. They did it to keep things going. Let's talk about the housing market for a minute here. We are seeing some rising inventory in many major markets here. Let's go ahead and start off here with San Diego. Recent rise in inventory here. We're back to where we were going into the health crisis 2020. So will inventory continue to rise? It'll bounce up and down seasonally, but looks like we're on an upward trend. Same thing for Phoenix, Scottsdale area in Arizona. We saw inventory drop down to about 4,000. Wow, in 2021. But now we're up to 13,000. So a tripling of inventory there in Phoenix. Let's take a look at Las Vegas. We dropped down at one point early 2022, under 4,000. Looked like about 3,700. Now, where are we at now? We're at 7,000. So a doubling there. Housing in Texas. This is statewide. This is pretty dramatic. We saw many people go to Texas. So, of course, inventory was low a year or two after the health crisis. And this is, of course, the whole state. So it's a higher number. 32,000 in early 2022. folks, now that's up to 115,000. So almost a quadrupling of inventory. And if you look at Texas now, it's the highest that it's been in more than 7 years. This chart only goes back to 2017. Actually, let's go back as far as we can. Yeah, that's the maximum chart. It doesn't go back farther than that. So this is the highest that it's been in 7 years as far as we can see, but we don't know beyond 2016 or prior to that what it was. It could be at a 15-year high. In fact, in our next housing report, we'll go further back as far as inventory. We'll go further back in Texas and some other areas that we need to keep an eye on. Let's talk about college degrees. There's a lot of students out there regretting their decision to get their degree, not getting a degree, but in getting the degree that they chose to get. But there are some degrees that actually pay off far better than others. And this was put out here recently, the degrees that are worth the most. So in other words, that people make the most in their careers after they get this particular degree. And we see engineering leading the way with the big bubble here, 571,000. Computer and information services, 477,000. Engineering and technicians, 311,000. Mathematics, 341,000. Business, 205,000. Now let's go to the smallest ones here. Let me see if I can enlarge this. And as I expected, the arts degrees are amongst the worst here. Visual and performing arts, 104,000 negative. Theology, 92,000. In other words, you're going to lose money between what you get in your degree or what you pay for your degree and what you actually make in your career, right? Pretty sad to think about that, isn't it? You spend all this time and money and it's a negative investment or a losing money investment. English language, 39,000 in the red. Communication technologies, 29,000 in the red. Here's another one, liberal arts and general studies, 13 in the red. That's 13,000. Psychology, 16,000 in the red. Education, 20,000 in the red. Wow, you would think education would be up there, especially with what these teachers have to go through with the way the kids act nowadays, right? I don't want to sound like an old fogey, but in my day, not everybody, but more kids respected their teacher. We still had troublemakers back when I went to school. But folks, watch what you get your degree in and be very picky and very choosy. When loans are really easy to get, especially student loans, they're backed by the government. So pretty much anybody can get a student loan. When loans are easy to get, people aren't as picky and choosy on what they use the money for. But when someone had to scrape and sweat to earn the money that they're using to pay for stuff, they're going to be much more choosy and more wise in what they spend the money on, right? That's just common sense. So that's another problem with easy money. It makes people spend recklessly and makes people spend without actually thinking about the consequences, right? So a lot of problems, folks, but also some good things happening on the horizon. Will we see a sound currency pop up here? We're going to watch the announcement here in a few days out of this BRICS meeting. We're going to see what happens. And we're going to keep an eye on everything here for you. The big picture, as always, please make sure you are subscribed and come back here for more news. Don't miss a episode, folks, because more news is coming out all the time, and we need to definitely stay ahead of the financial curve. Make sure you hit that notification bell as well. Thanks for all your support. Thanks for being here. Love to hear from you down in comments. We'll talk to everybody very soon. As always, keep stacking, everybody. Peace.